So welcome back to another tutorial session with Grand Majors Academic Support Services. Today we'll be turning our attention to manufacturing overheads. And the point to note is that we're still dealing with the main elements of production, right? And the main elements of production includes your direct material, your direct labor, and your manufacturing overheads. However, for this session, we'll be diving a little bit deeper into what manufacturing overheads are and how we go about accounting for them a little bit more detailed. So we say our direct material and our direct labor are our direct product costs, right? And they can be directly traced to a product. While on the other hand, our manufacturing overheads, these are our indirect product costs. And therefore accountants, because they're indirect and they can't be directly traced, accountants have to find a way to pass these costs on to the objects that we're making or to the products that we're making. And this is done through the use of the predetermined overhead absorption rate, right? The point to note is that your actual overheads are not known until the end of production, right? And because of this, you have something that we're going to be looking at with our OARs that we call allocated or budgeted overheads, right? And because we make this budgeted overhead at the onset of the production process, at the end of it, when we actually have our actual overheads, we can now make a comparison between the two. And the difference between those two is what we call our variance, right? And our variance can be an under-applied or an under-budgeted variance, or an over-applied or over-budgeted variance. And we'll take a little bit more in-depth look at what that means. And what we're saying here is that though this is for a manufacturing department, right, the same principle is applied when passing on indirect costs in a service entity. So though this is a manufacturing entity that we're talking about, and we're talking about OAR and manufacturing overheads, etc., the same principle applies to a service entity. And what we'll advise, as per usual, right, is when doing this topic and when looking at, your manufacturing overheads, what we'll say is to draw up your manufacturing overhead account. And what that is, that's a T account, right? Draw it up at all times. And what it shows you by drawing this up is that it shows you clearly the variance that is there, right? The difference between your actual and your budgeted. And showing you this variance, it assists with doing and writing up the proper journal entry to write off this variance. Because usually, unless in a perfect world, you'll have a discrepancy between your budgeted and your actual. And that's what we said we call the variance, right? This variance cannot just sit there. You have to write it off. So let's look at a question to start off. So here, Waiters Wood manufactures jewelry boxes. The primary materials, wood, brass, and glass, right? Those are our primary materials. Direct materials and direct labor are traced directly to the product. And this is evident because we know your direct materials, which are your primary materials, and your direct labor, they are directly traced to the product. So the next statement says, manufacturing overheads are allocated based on machine hours. What does this sentence mean? So remember we say, right, because indirect costs, those are your manufacturing overheads, you cannot directly trace them to a product. Accountant, we have to find a way to pass these on to the various products and objects that we make, right? How we pass this on, how is this allocated? It is allocated based on a cost driver. And I want you in the comment to give me a definition. It doesn't have to be the Oxford Dictionary's definition, but what your understanding of what a cost driver is. And I'll hint at it for you. It's what drives the cost for a particular department or a particular product. So here, for this business, they're saying manufacturing overheads costs, they are driven by, they're allocated on the basis of machine hours. So as machine hours go up, your manufacturing overhead costs will go up, right? So our cost driver here, and it's important to note your cost drivers in these type of questions. So from the onset, we can say for this business, the cost driver is machine hours. We're noting that. So then it gives us data for 2008. That's the year that we're doing these statements for, right? So we're looking at the columns first. We have the column with the headings and the names, but we also have two other columns that gives you some budgeted cost, and the other column gives you actual cost. So remember, we say to do OAR, right, or overhead absorption rate, we're using budgeted costs because we do not know the actual cost until the end, until we've actually finished making the goods. Then we can say, okay, it actually cost us this. But in business and in planning, right, we have to budget. And we budget either based on prior information or industry standards and information, right? So let's go into it. So we have budgeted and actual information for machine hours. What did you say machine hours was? Machine hours here is our cost driver. We have it for maintenance labor, which is repairs to equipment, for plant supervisors' salaries, for screws, nails, and glues. We have it for plant utilities, freight out, depreciation on manufacturing plants and equipment, and also for advertising expenses. So essentially, these are expenses, these are costs, right, to the business. So what is required of us? 1, calculate the predetermined manufacturing overhead. The predetermined manufacturing overhead, what we say that is, or OAR, right? It's another name for overhead absorption rate. And 2, post actual and allocated manufacturing overhead to the manufacturing overhead T account, right? So what we're going to be doing is drawing up our T account for manufacturing overhead and posting the actual cost. Remember, actual cost is known at the end of production. And here, remember, we have 2 columns, budgeted and actual, right? And then it says to close the overhead variance to the cost of goods sold. So remember what I said, because your actual is known at the end of production, right? And what you do with your overhead absorption is to tabulate an allocated or a budgeted figure. At the end of the day, you're going to have a discrepancy, a difference, and that's your variance, right? But your variance doesn't stay there. You have to close it out. And here it tells us that we close the variance to cost of goods sold. So let's get into that. So our formula for our overhead absorption rate or predetermined rate is total estimated overheads, right? The same as total budgeted overheads, and that's divided by total estimated units of the cost driver, right? And the cost driver, it's the primary factor that causes a cost, right? That drives costs related to the production process. So let's find this information for a question. We need to find the total estimated overheads, estimated, budgeted, right? And the total estimated units of our cost driver. And in this question, we said our cost driver was our machine hours, right? So let's find our estimated overheads. So remember, overhead costs, these are our indirect costs, right? So estimated, we have 2 columns, budgeted and actual. So we're saying estimated is the same as budgeted. So the figures that we'll be taking up is coming from the budgeted column, right? So let's go through and we're going to see which of these costs we'll be including in our overheads, right? So machine hours, no, that's not a cost. That's our cost driver, right? And it's the estimated cost driver. So we're using the 28,000, not the 32,800. So what's going to go at the bottom of our formula where it says total estimated cost driver units, that's 28,000. Jumping the gun a little bit, just want to point it out because it's there. So let's look at the cost. Maintenance, labor. Will we be using that? Yes, that's one of our overhead costs. Plant supervisor's salary. Yes, that's another that we'll be tabulating to find total estimated overheads. Screws, nails, and glue. Yes, that's another one. Plant utilities. Yes, that's another one. Freight out. What is this? This is your shipping, right? The cost to get it to the consumers, etc. Is that an overhead cost? No, we're not using it, right? But we're taking up depreciation on manufacturing plants and equipment. And the last one, advertising expenses. Are those manufacturing overhead costs? No. So the costs that we're using to tabulate or estimated manufacturing overheads are these 5 that are ticked. Those are overhead costs. And our formula says total estimated overheads, right? So we add all of those, the 12,000, 42,000, 23,000, 48,000, and 85,000. We're dividing by our total estimated units of the cost driver, which is 28,000 machine hours. So here we have 210,000 divided by $10,000 divided by 28,000 machine hours. And that gives us $7.50 per machine hours. And here your units is very important because we're saying machine hours into dollars gives you dollars per machine hour, right? So we would have finished one where we calculated our predetermined manufacturing overhead rates, or OER, right? So next comes posting the actual and the allocated manufacturing overhead to your manufacturing overhead T account. So let's look at what that looks like. So this is what your manufacturing overhead account looks like, the T account. You can actually see it's a T, right? You have the heading on top. But on your debit side, and your debit side for you is your left side, the left column. This is where actual manufacturing overhead is placed, the actual cost, which is the actual indirect material, actual indirect labor, depreciation, plant, anything related to the factory, the plant that are actual cost goes on your debit side, which is your left side. And on your right side, which is your credit side, is where you put manufacturing overhead applied. And we'll look at what that is, right? Because nowhere in the question really tells us manufacturing overhead applied, but this is something that we calculate, right? So the difference between actual overheads, which is on your debit side, right, and your applied overheads is referred to as the variance. So from this sentence and based on what we would have said before, you're seeing, okay, the applied is the budgeted, right? What was applied to it is the budgeted. And your budgeted is what you calculate at the onset of production before it finished. So here we're seeing, okay, the applied is something that we might have to calculate, right? The next point, this variance, which is the difference between the two, it can either be underapplied, right, which is adverse, not favorable, because you don't want to be underapplied. Underapplied means you wouldn't have put aside enough resources, right, for your actual cost. And over applied, it is more favorable in comparison to under applied, but if you're really supposed to make a detailed comparison, analyze it, it's not that favorable. What it's saying is that you can cover your actual cost, leaving additional, but that additional is actually a wastage. You could have used that additional to do something else. But a comparison between the two, over applied is more favorable to under applied, right? So let's continue. So back at the question. So remember, our actual cost goes on our debit side and our applied goes on the credit side. So what we're going to be doing is this time where we'll be going to the actual column to get all our actual overhead costs. And the thing to note is that all the actual costs that we're picking up are similar to the budgeted costs. However, this time, the only difference is that we're using those in the actual column. So your maintenance labor, that's still an overhead cost. Supervisor's salaries, the screws, the utility, and the depreciation, those are our manufacturing overheads, right? Freight out and advertising are not manufacturing overheads. So despite the fact that you have budgeted and actual information for it here, it's just a distraction, right? We won't be using it. So what we're doing is taking these actual costs and we're putting them on what? The debit side, right? Because actual cost goes on our debit side. What we do next, we need to find the applied, right? And we said before that this is something we have to calculate. So how do we find allocated manufacturing overhead? That's another name for it. Applied manufacturing overhead, budgeted manufacturing overhead. Those are all the names you can refer to it as. And how we find that is we say the actual units of the cost driver, and our cost driver was what? Machine hours. But this time we're using the actual units, right? And we're multiplying that by our OAR. So our OAR before was $7.50 per machine hours. And our actual cost driver was 32,800 hours. So putting that together, doing that multiplication would have gotten 246,000 to be or applied. And we call that working process, right? So now that we would have put in all the information that is required, we have our actual and we have our applied. We need to now do what? We need to find the variance and to close out the variance, right? So how do we go about finding the variance? So here we have to actually close the account. And there's a video from financial accounting about closing a T account. I will try to link it in the description for you to get more practice on closing the manufacturing overhead account. But what are the steps? So the steps, we first find the sum of both sides. So on our credit side, the sum would have already known that to be 246, right? But the sum on our debit side would be 279,350. So we're seeing that our debit side is greater, our actual is greater, right? That's already insinuated here than or allocated. So we find the sum of both sides. We're seeing, okay, what's the larger amount, right? The larger amount is 279,350. So that's gonna be our total. So what we do, we draw that first line, then we put the total there and we double underline it. What we do after that is to find the difference, right? So the difference between what is actually here and the larger amount. So the difference here is 33,350. So what we're trying to do is to make both sides equal, right? We're trying to make both sides equal. And to make both sides equal, we have to add 33,350 here. The difference, the variance. So it's varying by 33,350. So once you put this difference on the smaller side, we can now see for sure that both sides are not equal. This 33,350 is your variance, right? So what do? You can either leave it there and you bring it down as balance CD. And as I said, I will link it down and you'll see how to close an account. However, the next step, now that we know our variance, right, is to close the variance. And where do we close it to? The cost of goods sold account, right? So we know we do that by doing a journal entry. And our journal entry is a debit and a credit to an account, right? So what are we going to debit in this case and what are we going to credit? We know the figure because the figure is your variance, right? The 33,350, but to what account? So for one, we should know that something is going to go to the manufacturing overhead account. We're either going to debit or credit it because it is the account that we're closing, that we're disposing of, right? And okay, looking at the manufacturing overhead account, where is this variance on? What side is it on? It's on the credit side. So from the onset, we know, okay, to close it, we're going to credit manufacturing overhead. But what's the other entry? What's the other account? In the question, it told us, close it to cost of goods sold. So here the debit is inevitably going to go to cost of goods sold because it told us. So here the journal entry to dispose of the variance, debit to cost of goods sold, 33,350, and a credit to the manufacturing overhead account of the same 33,350. So this is the end of our question, right? If you have any questions or comments, you can drop it down in our comment section. Remember, if you haven't, subscribe to our channel to keep us going. Share this video with anyone you know who's doing this course, who'll be doing it in the future for practice, or anyone you know who just wants this information. And remember, give us a thumbs up on this video. As per usual, you can reach out to us via email or Instagram account. So until next time for a question.